Hello everyone, I'm Novalui, the Head of Investors Advisory at RHB Bank. Welcome to our monthly Investment Insight podcast. In the month of April, emerging market, especially China, has outperformed the rest of the developed market equities. This is continuing its uptrend for the past 3 months. Offshore Chinese equity market and Hong Kong have performed better than the onshore Chinese equity market. Despite recent recovery, Chinese equity market remains as low as 50% below its level comparing to 3 years ago. Drop in the past 1 month has trimmed US-related equity performance to low single digit, mainly driven by delay in Fed's rate cut and rise in Middle East geopolitical tension. US economy remains relatively strong, with strong job data reflected in non-farm payroll and increase in CPI numbers. Fed Chairman Jerome Powell commented that with such trend, it doesn't appear that they are able to reach its inflation target of 2%. Hence, there is less likelihood for rate cut happening anytime soon. The latest market expectation is 2 times rate cut towards end of the year in September and December. However, this remains fluid and very data dependent. Despite delay in the rate cut by US Fed, the European countries are more ready to cut interest rates sooner than later. For example, Switzerland's central bank has cut its interest rate since March this year by 25 basis points. Geopolitical tension escalated in Middle East when Israel was attacked by Iran, which was mostly neutralized. Equity market crashed on fear of full-blown war in the Middle East. Despite generally positive corporate earnings, some mega-cap tech companies drop when forecast announced is below analyst expectation, or when in doubt of the company's future investment. Investors are advised to invest in the broader sector and geographical areas within the developed market. China's monetary policy remains relatively accommodative in China, despite there is some concern on the property sector as a whole. On the comforting note, China is expected to roll out more policies to support the financing of real estate developers while improving the effect of policy implementation, amid increased efforts to improve their liquidity, thereby boosting the healthy development of the real estate industry. Ample policy remains available for China, for example, to reduce home purchase restriction and lower mortgage rates. This is also shown in Hong Kong, where additional stamp duties are waived, including those for purchase of second properties, as well as duties on those selling flats within 2 years of buying them. Back to our home country Malaysia, outflown by foreign investors jumped to 1.59 billion. This is partially contributed by overall risk-off sentiment following the surprise attack by Iran to Israel and Fed's decision to delay the rate cut. On top of infrastructure projects such as Penang LRT and potential revival of HSR, Nvidia and Microsoft has both announced their plan to invest in Malaysia on AI and data center infrastructure. Prime Minister is also having discussion with Google, however details are not available as we speak. Referring to above table, all major market tracked by us shown double-digit return on the aggregate analyst view for all the underlying shares in the indices. Both do note that KLCI appear to show a single-digit return. However, for a relatively small emerging market like Malaysia, it's possible for a fund manager to achieve excess return against the benchmark. Just for an example, for a fund below, which has gained 30% return within 1 year time frame with relatively low volatility. With the latest update we have shared, we aim to provide a clearer picture of current market dynamics. Despite April's correction, the majority of equity markets have maintained positivity over the past 3 months. We maintain optimism regarding equity markets for the remainders of the year. However, we advise investors to diversify their exposure across broader range of sectors and market. It's prudent for investors to strategically realize profits or reduce exposure where appropriate. This doesn't mean to totally exit the market, but rather taking a balanced approach to reduce position in areas with limited upside potential and to reallocate to safer areas with growth prospects. Given the current market volatility, clients may benefit from considering equity strategies that offer income payout, including dividends and equity premiums, while still capitalizing on potential market upswings. Emerging markets have stabilized and exhibit strength in the past 3 months, prompting investors to contemplate diversifying their allocation between developed and emerging markets. As we outline the investment theme for quarter 2, it's crucial for investors to reassess their portfolio and rebalance them in light of the latest market developments. We appreciate your participation in our monthly investment podcast and hope that this insight assists you in making more informed investment decisions. For further updates, please visit the RHB Merge website to access our latest Money Chat and podcast series.